Alright, let's get right into it. There is so much buzz, so much hype, and honestly a lot of confusion surrounding something called the Pi network. You've probably seen it on social media, or maybe a friend sent you an invite telling you to start mining crypto on your phone for free. The basic idea behind Pi network is incredibly simple. It presents itself as the first cryptocurrency you can mine on your mobile phone without draining your battery or needing a supercomputer. This accessibility is its main selling point. All you have to do is download an app, create an account, and then tap a button once every 24 hours to prove you're a real person and continue earning Pi coins. This concept has attracted a massive following. We're talking about tens of millions of users worldwide who are all diligently tapping that button every single day, accumulating Pi coins in their digital wallets. The project was started back in 2019 by a team of Stanford graduates who wanted to make cryptocurrency accessible to everyone, not just the tech-savvy folks with expensive mining rigs. Their mission was to build a secure, decentralized, and user-friendly digital currency. The idea is that by distributing the coin to a huge number of people before it even has a monetary value, they can create a robust and widely used peer-to-peer economy. It's a grand vision, and one that has captured the imagination of many. But here's where the big question comes in, and it's the reason we are all here today. These coins that millions of people are collecting currently have no official monetary value. That's right, zero. You can't trade them on major exchanges like Binance or Coinbase. You can't cash them out for dollars, euros, or any other currency. Before we can even begin to tackle that massive $314,159 price tag, we need to understand a crucial concept in the crypto world: stablecoins. Now, I know what you're thinking. Crypto is famous for its wild price swings. Bitcoin can jump or drop thousands of dollars in a single day. That volatility is what scares a lot of people away. A stablecoin is designed to be the exact opposite. Its entire purpose is to maintain a stable value, to be a safe harbor in the often turbulent sea of digital currencies. Think of it as a digital version of a traditional currency like the US dollar, but with the benefits of blockchain technology. So, how do they actually work? The most common type of stablecoin is what we call fiat collateralized. For every one digital coin in circulation, there is one real US dollar or another fiat currency held in a bank account as a reserve. A perfect example of this is Tether, USDT, and USD Coin, USDC. If a company issues 1 billion USDC tokens, they should have 1 billion US dollars in an audited bank account to back it up. This one-to-one backing keeps the price stable at, or very close to, $1. It's a bridge between traditional finance and crypto. Stablecoins are the backbone of DeFi. So let's talk about the elephant in the room. The astronomical price of $314,159 for a single Pi coin. Where on earth did that number come from? It wasn't pulled out of thin air. The number is a direct reference to the mathematical constant pi, which is approximately 3.14159. This has led to a powerful and viral narrative within the Pi community. The idea is that the coin, named Pi, should naturally have a value that reflects its namesake. It's a clever, symbolic, and incredibly sticky idea that has fired up the imaginations of millions of users who are hoping their daily taps on a phone app will turn into a life-changing fortune. This rumor gained significant momentum through social media. Twitter, Facebook, Telegram, screenshots began circulating showing supposed barter transactions where goods and services were exchanged for Pi coins at this consensus value. For instance, you might see a post claiming someone sold a car for 0.001 Pi, implying a valuation of hundreds of thousands of dollars per coin. These posts often come with hashtags like Pi consensus value, Pi network, creating an echo chamber where this belief is constantly reinforced. The community itself is trying to will this value into existence by agreeing that this is what it's worth. This phenomenon is what's known as a social consensus. It's the belief that if enough people agree on a price, the market will have to follow suit. Proponents of this theory argue that value is subjective. They point to art, collectibles, brand names. They argue that with over 55 million engaged users, the Pi network has the manpower to establish a new economic paradigm. It's a powerful and romantic notion, suggesting a grassroots movement against the established financial system. However, it's crucial to distinguish between these community-driven barter agreements and actual liquid market prices. During the enclosed mainnet period, there is no official way to buy or sell Pi for cash. Let's do some simple math. Apply a heavy dose of reality. $314,159 dream. Could one Pi coin ever be worth that much? To put it bluntly, the chances are infinitesimally small, bordering on impossible. It's not just unlikely, it would fundamentally break all known principles of economics and market capitalization. Market capitalization, or market cap, is a simple formula. It's the current price of a single coin multiplied by the total number of coins in circulation. This number gives you the total value of the entire project. Let's apply this to Pi network to see just how absurd this valuation truly is. The total supply of Pi is capped at 100 billion coins. Let's be generous and assume that only about 30 billion of those coins are currently in circulation among the user base. If a single Pi coin were worth $314,159, the total market cap would be 30 billion multiplied by that price. That comes out to roughly $9.42 quadrillion. For perspective, the entire GDP of the planet Earth is around $105 trillion. This means Pi Network's value would be about 90 times greater than the entire world's economy. It would be worth more than all the money, stocks, bonds, real estate in the world combined. Let's compare this to Bitcoin. At its absolute peak, Bitcoin's market cap reached around $1.3 trillion. That number is a tiny fraction, less than 0.014% of Pi's hypothetical market cap. This isn't opinion, it's basic arithmetic. The numbers just do not add up. When you're trying to understand a new project like Pi, it's helpful to compare it to the established leaders in the space. Bitcoin, Ethereum. These two cryptocurrencies are the giants of the industry, but they operate on very different principles than what Pi Network is proposing. Understanding these differences is key to managing your expectations. Bitcoin is often called digital gold. Its primary value proposition is scarcity. There will only ever be 21 million Bitcoin. That hard cap is written into its code. Its network is robust, it's decentralized, and highly secure. All of this makes Bitcoin a store of value. Pi Network takes the opposite approach. Rather than scarcity, its strategy is mass distribution. Total supply, 100 billion coins. Designed to be abundant, not scarce. The goal isn't to store value like gold. It's meant to be a medium of exchange. Buy coffee, pay for services online. Pi prioritizes getting the coin into as many hands as possible. Ethereum is more like a decentralized world computer. Its main innovation, smart contracts, self-executing contracts with terms written into code. That enables developers to build dApps for finance, gaming, art, social media. With all this speculation and hype running rampant, it's incredibly important to go directly to the source and see what the Pi core team, the actual developers of the project, have officially stated. Their communications have been consistent and clear on this topic, even if it's not the message that many of their users want to hear. The core team has never, not once, assigned a monetary value to the Pi coin. They have repeatedly warned users against unauthorized listings and speculation about the price. They are very deliberate in managing expectations and distancing themselves from the wild price predictions circulating online. In their official blog posts, FAQs, and in-app announcements, the team emphasizes that Pi is currently not on any exchange and has a value of approximately zero. They state that the value of Pi will ultimately be determined by the market once the open mainnet is launched and the coin can be traded freely. They explicitly warn that any exchange claiming to list Pi or a Pi IOU token is not affiliated with them and is operating without their consent. They caution users to be wary of scams and not to participate in such sales, as they could result in a total loss of funds. The team's focus remains firmly fixed on building the project's infrastructure and utility. Their roadmap has three main phases: beta testnet and mainnet. We are currently in the enclosed mainnet period, which is a crucial intermediate step. The primary goals during this phase are to allow for mass KYC verification to ensure all users are real individuals. While mining Pi on your phone seems harmless, after all it's free and doesn't drain your battery, there are several real risks and considerations that everyone involved should be aware of. The first and most obvious risk is that the project may never fully launch, or that the coin may end up being worthless. The transition to an open mainnet has been delayed multiple times, and there is no guaranteed date for its release. It's entirely possible that after years of tapping a button, the accumulated coins will have no monetary value. The time and effort you've invested, while minimal on a daily basis, could amount to nothing in the end. Another significant risk involves your personal data. To move your mined Pi to the main net and eventually be able to trade it, you must complete a Know Your Customer or KYC process. This involves submitting sensitive personal information, including a copy of your government-issued ID, like a passport or driver's license and a live selfie to a third-party verification service. While the Pi Core team assures users that this data is handled securely, handing over your personal identity documents to any online entity carries inherent risks. Data breaches are common, and your information could potentially be leaked or misused if security measures fail. There is also the risk of opportunity cost. While you are not investing money directly, you are investing your time, attention, and social capital. Many users spend time convincing their friends and family to join their security circle to increase their mining rate. This effort could have been spent on other activities, including learning about more established and transparent cryptocurrency projects. The hope of getting rich for free can be a powerful distraction, preventing people from engaging with the crypto space in a more educational and potentially more fruitful way. The focus on a single highly speculative project can create a form of tunnel vision. So, after breaking it all down, what's the final verdict? Should you be excited about Pi Network, or should you approach it with extreme caution? You need both, but lean much heavier toward caution. The excitement is understandable. It represents a dream. Financial empowerment for the masses accessible to anyone with a smartphone regardless of wealth or technical skill. A community-driven currency is powerful. Pi has built an impressive global network, but that excitement needs a reality check. $314,159 price target. Complete fantasy. A marketing myth with no economic basis. Chasing that without understanding the numbers leads to disappointment. Big hurdles, a delayed launch, building an ecosystem from scratch, likely huge selling pressure on market entry. Real risks, data privacy, uncertainty about the project's future. Don't overlook those. Beginner advice. Treat Pi as a social experiment, not an investment. It's okay to participate. Press the button every day and see what happens. It costs you no money. Time commitment is minimal, but don't put all your hopes into it. Keep your expectations grounded. Hope is not a strategy.